Thank you for listening, and I want to talk to you about a little bit about exam technique and a little bit about how marks are earned, and to throw in a bit of a surprise as well. I came across this image the other day and it absolutely tickled me. It absolutely made me smile. The image is trying to get the question to fit into the answer. Don't do that. It's the answer that's got to fit the question. That's what you should be doing. You should be designing your answer, writing your answer, which is unique and bespoke to the original question. So don't go into the exam with a preconceived sort of answer that you regurgitate out. Yeah, make sure you read the question. Now, in reading the question, the requirements of the question are signposting you very specifically to particular parts of the question. So you don't have to read a full 30-mark question in its entirety to answer the question. Now, this is from the March exam, March 20 exam, and you can see it's a massive 30-mark question. But really, it's A and B and C and D. And A is how the functional currency of crotchet can be determined. Now, maybe it's not clear to you, so let me emphasize it even more. In order to answer A, you only need to really properly digest the first paragraph of information, which is also entitled Functional Currency Crotchet. This requirement highlighted is answered from that information. Obviously, you need to read the background first. That requirement of part B is all about how crotchet contracts are dealt with, how you calculate goodwill, and there is all the information. And that will be in the computer-based environment. That is a separate that's a separate exhibit. All right, so in the paper they're broken down into these parts. In the CBE they're exhibits, and so one requirement relates to one exhibit. That's the name of the game. That's the way questions tend to be structured. So it's about quickly reading the whole question, but then when it comes to identifying how you go about answering the question, don't spend too long reading the whole question. If you're doing part A, read about the functional currency. If you're doing part C and quaver, concentrate on the acquisition of quaver. If you read all of the exhibits, if you read all of the information before you start, you'll get a headache. Part D exclusively relates to the impairment of bonds. It's a standalone exercise. I would advise you to do the questions in the order that they're set, because sometimes they have a rhythm. But actually, in this particular question, you could have done part D first. It's an absolutely standalone. D relates to that information. I just wanted to get that out of the way. I wanted to say that. Now, here's a bit of a tease. I want you to understand why you're being given information in the question. So if you're being told that management have decided to sell an item of PPE, which standard? Which standard? Yes, held for sale. Yeah. If you're being told that the company has green credentials and has installed an oil rig in the sea, which standard? Yeah, provisions. You have a constructive obligation to decommission. So you recognize the cost of decommissioning in full, you measure it at present value, you capitalize it, you unwind the discount, you depreciate the capitalized asset, blah, 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 blah. The company is guaranteed a loan taken out by the director. One issue. Several different accounts. Why would you be told that? What are you being told? You're being told the company has transacted with a director. The company transacting with a director is a related party transaction. The company's got a guarantee. Is it going to have to pay it? Is the director going to default? If it's possible, then I guess you've got a contingent liability. If it's probable, then you would have to recognize that as a liability. But actually, it's probably not going to be probable, is it? But actually, in giving that guarantee, the company's entered into a financial instrument. And financial instruments have to be recognized at fair value. And you can come up with an expected value. You can come up with a measure of the company's responsibilities here, because if the director has taken out a loan of 100 million, a personal loan, and we've guaranteed that, and there's a 5% chance that the company would have to meet that obligation if the director defaulted, if there was a 5% chance of that happening, you could therefore say the expected value and therefore the fair value is 5 million. And IFRS 9 takes that approach. So it's really important you understand why you're given the information. In answering questions, 1 mark at a time, make sure you look at the marking guides. Make sure you tailor the length and quality of your answer to the number of marks available. If it's only worth 3 marks, even if you write an essay, even if you write 5 pages, the marker can only give you 3 marks. If it's worth 8 marks, there's an indication there, surely, that you should be writing more than just 1 or 2 things. Yeah? I hope this is common sense. Plan your answer in relation to the situation. So if it's a particular 5-mark question, often what you're doing is you're identifying the issue, you're coming up with a definition, you're discussing and applying and discussing before you conclude. So if an asset perhaps has been damaged, you're identifying that that is an impairment, you're explaining what an impairment is, you're looking at the information about what you could sell it for, what you could repair for it, yeah, the fact that it's perhaps a non-cash expense or something like that, and then you arrive at the conclusion that, you know, what the impairment loss might be or whatever. Try and put your answers into mini paragraphs. It's easier if you're doing the CBE because you can physically edit, but if you're doing a handwritten exercise, you have got to think momentarily before you write. But try and put yourselves in the shoes of the marker. Yeah, and try and earn a mark and then leave a space. Try and earn a mark and then leave a space. I'd like you to read this answer. Fido has a machine that is damaged and wants advice on how to account for this. 3 marks. There are various indicators of impairment, some external, some internal. Have a read. How many marks would you give it? How many marks would you give it? If I'm honest, I'm not that impressed. I'm not that impressed. If I'm honest, I'm giving that 1 mark out of 3. That's a better answer. I mean, visually, it's earning 3 marks, isn't it? 1, 1, 1. Visually, it's like breaking it down. Why is this answer better? That Fido's machine was damaged. We're talking to Fido. We're not Google. This answer is not giving any advice. This answer is just rote learn rubbish that is dumped. It's Google. This answer is what you should be looking to try and achieve. Something that answers the question in front of you, that explains things. I would give this 3 out of 3. There's less words, Arguably, it's slightly less technical. I'm inspired by the book. I'm inspired by the Lord. I'm inspired by the examining team and what they write. I read the examiner's reports. So should you. This is a very powerful statement. I want to do another marking exercise with you, and this is based around a past examination question for 8 marks. And if I'm honest, this past examination question for 8 marks was a bit of a car crash in the exam. Discuss why the disclosure of sustainable information has become an important and influential consideration for investors. 8 marks. There's an opening blurb there. This is from the same exam, SBR. If you write nothing, you get no marks. I mean, let me show you briefly what the examiner wrote. Yeah? Environmental, social governance. I mean, on the one hand, it's beautiful. On the other hand, it is absolutely unobtainable. Nobody wrote this answer in the exam. Nobody did. I mean, this is an answer. That's the point, isn't it? You've got markers who are experts. You've got humans who are marking your script. And they read this and they know that that's not what they're going to read. It's not like numbers. It's not like a narrow definition. This is a very wide open area. And I sort of hesitate to do this, but I'm going to show you the marking guide. And the marking guide was interpreted by the markers fairly loosely. Yeah. Why is sustainable information relevant? Does it provide opportunities? What about the valuation of the business? What about the risks? What about the screening strategy? It's, how the examiner thinks about breaking down the answer, but don't be too hard on yourself if in an exam situation you don't come up with that. You've got to come up with something. Yeah, that's the question. That's the question in front of us. And I want to show you an answer. Discuss why the disclosure of sustainable information has become an important part and influential consideration for investors. Some investors have ethical values. They are charities or religious institutions. Life is not all about money. Some bad spelling in there. Disclosures are voluntary, so they are doing for a reason, to meet the information needs, to reduce, I think that means risk. It is better if the disclosure was given in line with international global reporting guidelines. This would enhance, I think that's comparability. You do not lose marks for bad spelling. The cash flow statement is a useful place for investors because cash is necessary for going concern and therefore sustainability. Investors want dividends. Oh, yeah. On the face of it, I agree with that statement. Investors are interested in the sustainability of the business because if the business has no future, then it will not get a return on investment. And it's for this reason that some investors have sold their holdings in traditional oil companies. if you were a marker, if you were looking at that answer, those words are not found in the examiner's answer. You have 8 marks that you could give. How many marks would you give for this answer? Don't take off anything for spelling mistakes. This is my view. I would give a mark for the first paragraph. The first thing that, ethical, there are such things as ethical investors. I think I would give a mark for that. And actually that second point, I think I would give 2 marks, because there's a mention of risk, there's a mention of sort of voluntary disclosure, and then there's a mention of these global reporting guidelines and how that would enhance comparability. So even though it's like 1 paragraph, and maybe a better way of structuring it would have been to make that 2 paragraphs, I am prepared to give that 2 marks for that second paragraph. Top right hand corner. No spelling errors. Absolutely true, but doesn't do it for me. It's not answering the question. I don't see that there is a specific point about sustainability in that it just says cash flow is useful, they want dividend. I mean, not applied. But I do think so. I would give this answer 4 out of 8. 4 out of 8 is a pass. Takes a bit of thinking about, takes a bit of balls. You've got to give it a go. You write something down. There's no negative marking. No negative marking. Got to give it a go. What have you got to lose? Anyway, that was very quick. If you're revising and you want something slightly different and you haven't come across my podcast, have a listen to my podcast. It's there on Spotify. It's there on other platforms as well, but perhaps the easiest way to find it is Clendon. Put in Google Clendon and podcast, and you'll find it. Yeah, various platforms. Now, let me throw in a surprise for you for having listened so far. And I want us to think about how we might go around accounting for a 5-year interest-free euro loan. I want you to think about how you would account for a 5-year interest-free euro loan. And think about that as potentially being worth 8 marks. Now, if it is worth 8 marks, you've got to give and go again. You've got to come up with a number of ideas. Now, I think there are several different accounting standards at play here. First of all, you've got a loan. We've borrowed money, so we have an obligation to pay it back. And that's a financial instrument. And that liability has to be initially measured at fair value. And because it's an interest-free loan, if we're receiving 100 million today, we've only got to pay back 100 million in 5 years' time. So actually the liability is smaller than 100 million in today's monetary terms. We debit cash 100 and we credit liability by, 95. You present value, you discount the obligation to pay 100 million in 5 years' time in today's monetary terms, and you've got a difference, you've got a gain. So there's 2 marks there, I think. It's a liability, it's initial recognition, it's at fair value, you've got a gain arising, you're better off. Of course you're better off. You've received an interest-free loan. Why have you received an interest-free loan? You've received it from the European Union. And the European Union are a government. They're helping you. They're giving you a soft loan. So part of that is therefore about government grants. And having measured that soft loan at 95, having measured that soft loan at the present value, subsequently you're going to have to amortize it. There's going to be an unwinding. There is going to be a finance charge that goes through income statement. There is. Even though it's interest free, you're not paying any interest, but there will be a finance cost because we'll be charging based on the having discounted it. We're then going to have to unwind that discount. So every year there's going to be a finance cost that you debit the P&L and credit the liability to build it up from 95 to 100. So in your cash flow, you add back the non-cash expense, you add back the depreciation, you add back the finance cost, but you do show the interest that you've paid, which will be zero. It's a grant. It's probably, I don't know, if it's a revenue grant, the gain goes straight into P&L. If it's a capital grant, then you've got presumably deferred income, which you then release back to the P&L as you depreciate the asset that it's helping to finance. So it's a government grant. And what's the fourth area? I think each of these areas can be made into 2 marks. Yeah, foreign currency. It's in euros. You've been given euros. As an individual company, you've been given euros. You have a monetary liability in a foreign currency because the assumption is we function in dollars. So what you've got, therefore, is at the year end, a monetary liability in a foreign currency, which will therefore need to be retranslated at the closing rate with the exchange difference going to P&L. Yeah? With the exchange difference going to P&L. Okay. That was it. Bit of fun. Hope you found that useful.